Hello and welcome to our session on mergers and acquisition. Let's look at our objectives and a session overview. Now, in the course of a life of a business, even as they seek to grow, they may choose to grow in more ways than one. They may choose the path of sometimes combining with others or actually buying up existing firms so that they can expand. So for this session, we are going to go through the basics of mergers and acquisitions and their related issues. Now, at the end of the sessions, you should be able to at least clearly indicate the various pathways within the arena of mergers and acquisition. You should be able to explain legitimate and dubious motives for pursuing mergers and acquisitions and illustrate the defensive tactics that may be employed by firms within the mergers and acquisition terrain. Now, let's try to get some kind of definition. Now, in the field of mergers and acquisition, it involves the combination of two business entities under common ownership. So whenever we combine two businesses and give them one singular ownership in terms of an ownership body or a shareholding base, then we have a merger. Or that sometimes two firms can coalesce, meaning that come together and form one and share resources in order to realize a common goal. That is also considered a merger. In reality, however, one party almost always dominates. You can liken it to marriage. Two equal parties join, but one name dominates in the lot. Now, let's look at acquisitions. Acquisition, as the term goes, we are acquiring. So one firm buys the assets or shares of another. And then in a takeover, it actually implies that the acquiring firm is larger than the target. And the reverse takeover is if the target firm is larger than the acquirer. So for a reverse takeover, it means we find a smaller firm trying to take over a larger firm. Now, in trying to acquire, the firm can be acquired by another firm or individual by purchasing the voting shares of the firm's stock. So it means that we proceed to buy the shares of the firm that we are interested in. And then it can also be a tender offer where we make a public offer to buy the shares. When we go through the route of stock acquisition, it means we don't necessarily need a stockholder vote. And then we deal directly with the stockholders, even if management is unfriendly. It may, however, be delayed. Acquisition may, however, be delayed if some target shareholders hold out for more money. So then it means that we are acquiring a chunk of it, but when some hold out and want more money for their shares, it may delay the process. But a complete absorption then will require a merger. So now this is how it plays out. When company A and company B come together to form a completely new company, company C, we call it a merger with consolidation. Otherwise, when company X, which is larger than the company Y, and has company X becoming a bigger and company Y being completely subsumed, we have a merger or more of an acquisition. Now, when it comes to mergers and acquisitions, there are parties to these acquisitions. The target company, or known as the target, is the company being acquired. And then the acquiring company is the one acquiring the other. Now, based on the endorsement of either the parties' money, especially for the firm that is being acquired or being bought in code, it can either be a hostile takeover. That is when the target company board of directors objects to the takeover. On the other hand, it can be a friendly transaction when the target company board of directors endorse the merger or the acquisition offer. So now, another angle from which you can look at is how related the parties within the merger and acquisition are in terms of business activities. Now, we talk of a horizontal merger when we have firms that are in the same line of business coming together. So it's horizontal. They are on the same But when we talk of a vertical merger, it means that they are within the value chain. Value chain because somebody produces, somebody, so let's say if it's a farming deal, somebody grows, another one converts, and another one distributes. And then the distributing firm decides that they'll, maybe in this case, go backwards and then acquire the farm and then the value addition chain. So it means that at that point you've got a vertical merger. And a conglomerate is where they are not related at all. So they just acquire different pieces of businesses as they grow, moving into different areas. Now, there are motives for merging. There are motives that work at creating value, and then there are other motives. Now, in terms of value creation, typically, one of the key things is synergy, where the two entities coming together generate more value than individual firms separately. It also works with growth by, of course, helping economies of scale, etc. It can also increase market power. That gives them a chance sometimes to control price and other value components. And then in creating value by this merger, sometimes they acquire unique capabilities or resources that were otherwise not available to them. And sometimes it can unlock hidden values. Now, when it comes to another motive set, which we can categorize as cross-border mergers, it breaks down into avenues where we exploit market imperfections. So that where one market is not favorable, we can actually take advantage by merging with another so that we can take advantage of a different market. Then we also have the possibility of sometimes overcoming adverse government policy, because where a law maybe is passed that one firm or a particular country is no longer importing a product from elsewhere so that it must be locally produced, then the firms that were exporting to that country may choose to actually acquire the importing firm so that it's more of having it as its distribution chain and not necessarily one that is importing from them. So those are some of the things. It could also help with technology transfer. Also, cross-border mergers, product differentiation comes into play a game here. And then following clients. So we can cross borders because we are following clients. But then there are a few very dubious motives for merging or acquiring, which is diversification. It's not a good one. Bootstrapping, that's trying to make the most of earnings of another. For example, where one firm is making losses and so trying to merge with the other so that you can take the tax benefits that accrue to the negative earnings. That's not good enough. Then sometimes managers' personal incentives, which means that merging sometimes with another entity with the hope of generating bonuses, etc. And then other tax considerations, as I mentioned earlier. Now, the form of transaction can either be a stock purchase or an asset purchase. Now, when it comes to payment, either it is paid for in cash. It means that the shareholders or the firm that is being bought receive cash. In some cases, they can receive securities, meaning they can receive shares for the new company to be formed or the new company that will come up out of this merger. Or there are times there's actually a combination of cash and securities. Normally, the tendency is for the acquiring firm to pay cash if they think that there are good prospects to be accrued from such a deal, and will pay with stocks if they are not too sure of the future prospects. Now, the attitude of management towards a merger or acquisition can be hostile or friendly. Hostile if the board is not in favor, friendly if they are in favor and they buy into it. In acquiring stock, we have a tender offer, which is usually a public offer to buy shares made by one firm directly to the shareholders of the other firm. Now, if the shareholders accept the offer, they tender their shares by exchanging them for cash or securities. Now, a tender offer normally is contingent on the bidders obtaining some percentage of the voting shares. That way, if they get a required quantity, then it's fine. If not enough shares are tendered by the existing shareholders, then the offer might be withdrawn or reformulated. On the other hand, we can have a bear hug, and this one is usually when the offer is made by the acquiring company to buy the shares for a higher price than it is truly worth. What it means is that if the shares ordinarily were on the market for maybe 20 cedis, a bear hug, it may be offered, or there's a request to buy at 30 cedis per share, which means that the firm shareholders who choose to sell get a 10 cedi extra for each share that they sell off, which also means that, and it's usually used as a route if they are not, the acquiring firm is not too sure that management will be willing to sell. So they're trying to actually buy the shares of the shareholders using a very lucrative or juicy price. Now, we've already mentioned about the fact that mergers or takeovers, acquisitions can be friendly or hostile. So, as mentioned, friendly is when it is wanted and hostile when it is unwanted. Now, usually when the takeover is unwanted, the management of the firm that is being acquired, so usually it is the firm that is being acquired that considers the courtship unwanted, they can have some defenses. We've got poison pills, incorporation in the state with restrictive takeovers, staggered board of directors, restricted voting rights, supermajority voting provisions, golden parachutes. That's usually before the pre-offer. That's what is in there. But when the offer has been made, as in now, so before any offer whatsoever, these are preventive, literally, mechanisms. Now, when somebody actually goes on ahead to make an offer to buy or to take over, there are other mechanisms that can be triggered. The just say no defense, leverage recapitalization, crown jewel defenses, Pac-Man defense, white knight defense, white square defense. Let's get down to understanding. Now, poison pills are typically one of the most common defense against hostile takeover. So this is what it does. It gives a right offerings that gives the target shareholders rights to buy the target, usually at a very discounted price. What it means is that it dilutes. So if the price on the market is 50 and shareholders are allowed to buy at, let's say, 20 cedis, then within the shortest possible time, the market will be flooded with a lot of issued and outstanding shares, which then makes it very expensive for the acquiring firm to acquire, for which reason it actually can make the acquiring firm back off. So poison pills are usually measures of true desperation, and they seek to make the firm unattractive to bidders. But in the long run, they also reduce shareholder wealth. Then we have the golden parachute. Usually, this is an extremely lucrative severance package that is guaranteed to firm senior management the events that the firm is taken over and management are let go. So, in this regard, the golden parachutes, if it exists, management will be more likely to be receptive of a takeover, lessening the likelihood of managerial entrenchment. Then we have a white knight. Now this one is a defensive mechanism where in a hostile takeover attempt, the firm that is being acquired decides to look for someone they will choose rather to acquire them. completely. Now, for the white square, it's similar except for the fact that they look for another entity to acquire a sizable chunk of their shares, for which reason, without the relevant or the required quantum of shares, the acquiring firms will not be able to take over completely. Pac-Man Defense, the firm that is being acquired or being courted, turns around to try acquiring the original acquirer. Now, when it comes to analyzing mergers, normally the discounted cash flow technique is used in evaluation of the target company. So we value and determine the intrinsic value of the target company. And then looking at the free cash flows after capital expenditure to maintain the company as an ongoing concern. The idea is to determine that what is the value of this organization, and based on that, how much you pay for it will determine whether at the end of the day it comes up as a positive NPV project or NPV activity, a positive NPV activity. So if the value of the firm turns out to be like 300 million, and then you are able to purchase it for 200 million, that gives you an NPV of 100 million. And so at that point, you may proceed with the merger. So this, at this point, also brings us back to the relevance of discounted cash flow techniques and valuation in the arena of corporate finance. In summary, we need to know that acquisition is the purchase of some portion of one company by another, whereas a merger represents the absorption of one company by another. Mergers may be a statutory merger, a subsidiary merger, or consolidation. Horizontal businesses are in the same line of business. Mergers, they are within the same value chain. Conglomerates are quite unrelated. And so mergers usually can happen and go on. So waves of mergers and acquisitions. There are a number of motives for mergers. Some are justified, some are dubious. So it's important to know which reasons are good for merging and those that are not or cannot be justified for that. In general, there are a number of defense mechanisms that a target firm can use to ward off unwanted takeovers. It's important to know these and then know how they play out. We have come to the end of our lesson. I hope you enjoyed yourself. See you another time. Bye.